Hi everybody, this is Mr. Farmer. Welcome to AP Microeconomics. Today we're going to be quickly going over market structures, the four that are covered in the AP course, and then we're going to focus on perfect competition. Here we go. So first thing, one of the big things to realize about the different market structures is it's going to play a significant role is the idea of elasticity of demand most likely, and that's going to be because of the number of firms and how similar or differentiated the products are. And so you can see it is a little bit of a spectrum as far as, we go from perfect competition to monopolist competition to oligopoly, and then extreme we go to monopoly. So it is a bit of a spectrum there. There are some actual numbers to differentiate between these two. We're not going to talk about that here. So here's kind of a general table. So the number one thing to look at for the number of market structure is how many sellers are there. For our purposes, we're assuming there's a lot of buyers. If that's not the case, it's a very different aspect, and so we just assume there's lots of those. So if there's a lot of sellers, you're either perfect competition or monopolist competition. If there's only a few sellers, I think of like the soda beverage industry between Pepsi and Coke. It's a perfect example of an oligopoly. And then there's only one seller, that's a monopoly. If they have 100% of the market share, that's called a pure monopoly. Otherwise, if they have the majority, if it's above 50% of a market, I believe, they have monopoly power. For simplicity, again, we usually just assume it's one seller, but it actually could be more based on the criteria. Next thing is the products. So if they are, you can kind of see we're in this left-hand column. So if there's lots of sellers and the products are identical, another way of saying that is standardized, you're in perfect competition. So there's lots of sellers and they're identical products. That's super elastic. Okay, and that's very substitutable. So that's going to play a big role. If there's lots of sellers but they're slightly differentiated, I think like running shoes, okay, a Nike's not the same as an Adidas, the same as a Reebok, the same as a blah, blah, blah. There are some differences. And so they get some control over the prices, but they have to be within a certain price range. Oligopoly is the weird one because you can have either standardized products or you can have differentiated products. So because it has a fluid definition, we actually have to deal with that a little bit. And then monopoly, there's only one seller, so it doesn't really matter. As far as the entrance and exits for perfect and monopolist competition, it's pretty easy to get in or out of the market, meaning it's very low barriers to entry to get in. There's not a lot of startup capital, for instance. The ability to produce the goods, easy to do. It's an easy thing to do. Oligopoly, the reason why there's only a few sellers is it's very hard barriers to entry. Okay, very large startup capital, very hard to make a name for yourself, those kinds of things. And monopoly, it's near impossible to enter into the market, which is why they've maintained a monopoly status. Now, most textbooks say it's also impossible for a monopoly to exit. What they mean is they just want to have an easy way of saying it. If a company is failing, unless there's some kind of like a utility, like an electric company in California, be PG&E. PG&E is not allowed to go out of business because we can't rely on them for electricity, right? So in that case, it's a public utility. They would not be allowed to go out of business. The government would come and support them. Otherwise, if the company is non-utility based, yes, they can leave the industry. That's fine. And then finally, price control, which is how much control do the producers have over the prices. For perfect monopolist competition, we say they're price takers, meaning the industry pretty much dictates what the price is. And oligopoly, again, is kind of a weird one. Sometimes they're price takers, sometimes they're a price maker. It kind of depends on certain aspects. And then monopoly, they decide the price. So from now on, for the next little bit, we're going to focus on perfect competition. Okay, so it rarely actually occurs in the real world for a couple of reasons. One, goods are typically not truly identical, or the number of suppliers is not actually large enough. You look at farming agriculture, the number of farmers, true individualized farmers, is actually a lot less than you'd imagine. And so most things don't sit with that. Okay, they're slightly outside of it for one reason or the other. With that said, we do use them because they are perfect competition. They're kind of the bar to see, hey, this is what a super efficient market would look like. And so we can use them. We can also use them to figure out different rules that we're going to talk about today that we'll later use for the other market structures. The other three are referred to as imperfect competition, kind of as a group. And so we can use the rules we learned in perfect competition for the imperfect competition markets. So again, pure competition, perfect competition, large number of producers, products are identical, they're price takers, and entrance is pretty easy to go through. So products are perfectly elastic at the market to the customers for the individual firms. There's a large number of producers and the goods are completely identical. So that pretty much means that for the individual firm, the good is perfectly elastic because there's somebody right next door selling the exact same product. So the rest of this chapter is going to be focusing on that. Okay, a couple quick little definitions. And we've seen similar things to these before, so nothing too crazy. So we have average revenue, which we don't use that much, but it's sometimes on there. So that's going to be the revenue per unit, or essentially the price, because you have your total revenue divided by the quantity. And concerning total revenue, the second bullet point is your price times your quantity. If you just invert that, then you have your total revenue divided by quantity equals the price, aka average revenue. So price and average revenue are always equal. And then we have marginal revenue. We've done a lot of marginals. That's the change in total revenue divided by the change in quantity. Marginal revenue is horizontal because it is perfectly for perfect competition because of the elasticity. We're going to go into that a little bit more. So that is going to be significant. So pure competition. Here's the market. We've seen this before. What we've actually been drawing when we draw supply and demand is the market or the industry supply and demand graph. Now the firms are price takers. Whatever the industry price dictates, that's what the firms have to sell at. If they try and sell above that, nobody's going to buy that good. I'm going to sell this good for $10. Well, the rest of the market's selling it for $7. As a customer, I'm not going to go spend $3 more, right? And I'm not going to sell for less. I could be below my, be producing at a loss at that point. So there's no reason why I'd want to sell at a lower. So usually want to sell at a higher point. So if we carry that line across, we come up with the firm's demand curve. So it's called a side-by-side graph. You can imagine why. And so you have the market on one side, and then you have the individual firm on the other. Now, there's no standard way as far as which goes on the left and the right, but my default is what you see here. So you can see on the right-hand side, I have demand equal to average revenue equal to price. So DARP. So the reason why it's so flat, the reason why it's so perfectly elastic, you can see a perfectly elastic demand curve here, is because there's a large number of sellers and the goods are identical, meaning perfectly substitutable. Thus, the demand for the firm is perfectly elastic. Okay, so again, that's where those market structures of the definitions play a big role, is they go into the elasticity, which is going to have some more significance. So then we have this Mr. DARP, MR equals demand equals average revenue equals price. Why? The price stays the same. Consumers will only demand goods from the company if the price is at the previously identified price. So price equals demand, just always. That's not a perfect competition thing. The price equals the demand at that quantity. If the price stays the same, then if the price was $10 per unit and you sell 1 unit or 10 units, the total revenue divided by the quantity will always equal 10. Hence, price always equals the average revenue. The same is true with the marginal revenue. When I sold my first unit, I sold it for $10. When I sell my second unit, I get a total revenue of $10, or I got an additional revenue of $10. Okay? If I sell a third unit, I have a total revenue of $30, which means I've added $10 to my marginal revenue. So all that being said, for perfect competition, your marginal revenue will equal demand, will equal average revenue, will equal price. And this is because for perfect competition, there's a large number of sellers and the goods are identical. That's the only market structure that fits this. So for the other imperfect competitions, this is not going to be true. Okay, the demand will equal to average revenue equal to price. That's always there. Just the MR is not always. So we had our price at $10. Thus, the additional revenue will always be $10. So we got Mr. DARP. So there you go. Just a little caricature. Some people really like Mr. DARP. And Mr. DARP means, it's a way of remembering that MR equals demand equals average revenue equals price. Now on the AP exam, don't just write Mr. DARP. Apparently people used to do that. I'm not sure why. Because the equation is you have them equal to each other. Okay. Typically you need your margin revenue and you need your demand curve. And then if you draw it like this, where you draw your price and it clearly connects all the way across, that is stating that the industry is dictating the price, although it's always good to label as such that this price is the same as this price, indicating the firm is a price taker. Okay, so you usually do draw them in line like this. That's the easiest way of doing it. And the prices need to be identical. The quantities are not, because the quantity, the market quantity is all the firms, and the individual firms are going to be just for that firm, by the way. So profit maximizing. Profit maximizing is margin revenue equal to marginal cost, always. Okay, just like we had margin benefit equal to margin cost, and those kinds of ideas. Margin revenue, margin cost, that's profit maximizing for every market structure. The profit maximizing quantity is a quantity that is the potentially most profitable or the least loss for a company. It's the best potential reason why. Why? Every unit leading up to the intersection indicates the additional revenue earned by the producer is greater than the additional cost to produce that unit. So I gained this much. I gained this much. This is, you can kind of think of it as the level of profit. However, it isn't always profitable. Why? Because margin cost is only based off of variable cost inputs. So if the fixed costs are higher, the company may have a profit maximizing quantity that is not profitable. Okay, and situations along those lines. So just because you're at your profit maximizing doesn't guarantee you a profit. It says, well, that is the best potential spot for that. Okay. Once you have your profit maximizing, you can finally get your profit. So your profit is at that quantity was your total revenue minus your total cost. That'll be your profit. If you have your price, which is your per unit price, and you subtract out your average total cost, you now have your per unit profit. So if you multiply that by the quantity, then you have your total profit. And this will occur when your margin revenue is equal to marginal cost. The quantity or output where MR equals MC occurs will indicate the best outcome for it. And again, we call that profit maximizing output. And it's true for all market structures. So we got our graph. And by the way I usually draw this is I draw my supply and my demand graph. First, I carried that curve across. I then draw my marginal revenue equal to demand curve. I usually don't need the average revenue and the price. Price is over here. After that, I have my margin cost curve. So now I know that is the quantity that stuff is going to happen at. Okay, if you're talking about profit or loss, whatever else is, it's all going to happen at that quantity. So this is my firm's quantity. So I usually put QF, and then I have my market, which I usually put as QM, because they are two different things. You should label them as such. All firms are identical, so that firm is a representative firm for all the other companies in the industry. So they'll all produce that, a specific quantity. So if the firm produces 10 units, and there's 100 firms in the industry, how much would the industry produce? Just take a moment, think about it. Hopefully you got 1,000 units. Okay, just 10 times 100, 1,000. This is why we can't just put Q on the bottoms here, because these are two separate numbers. So QF for firm, QM for market is kind of what I typically do. And yes, you definitely need to be labeling the two different companies or two different graphs. Okay, there's a couple different possibilities. One is you might be producing at a profit. Okay, so profit occurs when your price at a certain quantity, your profit maximizing quantity, is greater than your average total cost. That would be like you have a price of $20, your average total cost is $10. So your per unit profit is $10. You could also break even. Okay, that's going to be at your profit maximizing. Your price is equal to the average total cost. So you have a per unit profit, and we're talking economic profits because we're in an econ class. So if your price and ATC are equal, then you have a per unit profit of $0. Okay, those two are the straightforward ones. Now we get into the less straightforward. So the last two are you're losing money. And again, we're in the short run. It plays a role here. So in the short run, if your price is less than your average total cost, you're losing money. Okay, but if your price at the profit maximizing is greater than your average variable cost, you're financially better off by continually to produce. You're minimizing your losses by producing. So your price is $20, your ATC is $30. All right, you're losing money. You have a per unit loss of $10. But if your price is 20 and your average variable cost is 15, you're minimizing your loss. Why? ATC minus AVC equals the AFC. So that means my average fixed cost is 30 minus 15. My average fixed cost is $15. So what's that mean? If I produce this good, my $20 can help pay off that $15 fixed cost. And then I can put the extra $5 towards paying off the other portions of the cost. So I'm going to lose less money. I'm going to lose $10 per unit compared to if I shut down, I still have to pay my rent. I still have to pay my fixed cost. So I lose $15 per unit. Even though I'm not producing, we'll still talk about that way for a second. And the last one is shut down. That's when your price is less than your average variable cost, therefore less than your average total cost. This means if I produce something, because variable costs only occur if you produce. Okay, I don't pay my workers if they don't work at all. So variable costs are called operational costs. They only occur when you operate. So if I don't operate, I don't have a $25 AVC. Which means if I produce, I can sell my good for $20. It costs me $25 per unit just to run the operations. So I'm losing $5. And then on top of that, then I have to pay my fixed costs. Well, in that case, it's better just to run out your leases, to not operate, and just wait until the long run, which we'll talk about later. So, breaking even. At your profit maximizing, you are, so I'm only going to do just the firm side of things. There will be a side-by-side graph over here, supply and demand. So, at my profit maximizing, MR equal to MC, margin cost, I am breaking even. Right there. Profit in the short run, your profit at the profit maximizing quantity, your price is greater than your average total cost curve. So you have a per unit profit of that vertical difference. And then you have your actual profit. Now, please draw rectangles. I have so many students that they want to go all the way down and follow the ATC curve for some reason. They want to follow the margin cost curve reason. No, once you have your profit maximizing output, the margin cost curve doesn't mean diddly squat. It's a means to an end. So at that profit maximizing output, what is my price? It's here. At that profit maximizing output, what is the average total cost? That means that's the average cost for all the units produced at that quantity. If I was producing at this quantity, the lower point, well then that would be for all the goods. So all the goods have an average cost of $10. So please draw rectangles when you're shading in profit. Okay, minimizing loss. So your profit is, you are less than your ATC. But greater than my AVC. So here we can see the orange is my total variable cost curves. So again, that only occurs if I run my operations. Then I have my total fixed cost is going to be in that blue area. What we can see is that this green area we have my total revenue. So by running my operations, I am reducing the amount of loss that I have. If I don't run my business, I owe the entire fixed cost, the entire blue area. So by running my operations, I'm losing less money, and then in the long run, things will change. So that's why we call this minimizing loss. And yes, you continue to operate in this situation. Last one, shutdown. Okay, profit maximizing. Even though we're not producing anything, we're profit maximizing. Okay, there's my total variable cost. There's my total fixed cost. And that green section is the amount that if I run my business, I'd gain that much in revenue. If I don't run my business, I'm only losing out on my fixed cost, the blue section. So the reason why this is minimizing losses is by operating, I'm losing out on my fixed costs plus the amount of variable costs I can't cover. I'm actually increasing my overall costs. So shutdown, financially, it's better to just not produce anything. So the quantity you produce is 0 units. You don't produce anything, you're shutting down. All right, so let's check where would a profit be, or minimizing loss, or break even, or shut down. So think about this one. Where's this? That's profit. That's minimizing loss. That's break even. And that's shut down. So short run versus long run. So right now we have the, there we go, move that down a little bit. So we assume the firm we draw is representative of the firms in the industry and that it stays in the long run. Just kind of clarifying that, okay? So we have the industry graph, we have a profit right now. So in the long run, firms can enter and leave the market. In perfect competition, they can do that pretty easily, actually. So if there's a profit, firms will enter in. Firms will continue to enter until the motivation to enter has been taken away. So firms are going to enter into this market. So the industry supply curve is going to shift to the right as more firms enter. What you might notice is that decreases the overall price because there's more producers, which is going to push the demand for the individual firm down. As more competitors enter into the market, the demand for each individual firm is going to decrease. And firms are going to continue to enter into the market until there's no longer motivation to enter. When would that be? When they break even. So in the long run, you will always be at a break even for perfect competition. So here we have a firm that's producing at a loss. It's actually minimizing loss because they're above the ABC. So in the long run, firms can enter or leave the market. And so in this case, firms are going to want to leave the market. So as firms leave the market, our industry supply curve shifts to the left, just like we talked about a long time ago. And that's going to increase the overall price as the goods become more scarce, and also decrease the quantity that the market is producing. But as more firms leave, that actually increases the demand for the firms that stay in. And yes, we assume whoever we drew, they're the lucky ones that stayed in. Just don't question it. Okay. And so the individual firms increase their demand, and so that's going to increase the price. That does also mean that the individual firm is going to produce a larger amount as there's less competitors. And once again, firms are going to continue to leave the market until they break even. Last thing to note, assuming no price floor or price ceiling, all firms in perfect competitive industry are allocatedly efficient. How do we know this? Because they're all equal to supply and demand and consumer producer surplus. So they're all allocatedly efficient. However, only a break-even firm is going to be productively efficient because they're producing at the minimum ATC. So let's talk a little bit about that productive efficiency. All right, so in perfect competition, the demand is equal to the marginal revenue. That's the whole perfect elasticity thing. Okay. They produce or they're profit maximizing, so marginal revenue equals marginal cost. In the long run, firms break even. As firms are able to enter and leave the market, they're going to continue to do so until they break even. So the demand is equal to the average total cost. So if I put all those things together, that means my demand is equal to my marginal revenue, which is equal to my marginal cost, which means my demand is equal to my ATC also. So that means we're producing MR equal to MC equal to the minimum ATC, marginal cost equal to ATC. So because we're in perfect competition, the fact that my demand is equal to marginal revenue means all of this is true, hence productive efficiency. In the imperfect competitions, the demand, I'm going to tell you, is not equal to marginal revenue, which means this is not going to be a thing for the other ones. Hence why this is again called perfect competition. They're perfectly productive efficient, in the long run guaranteed, and they're allocatedly efficient. That's why it's called perfect competition. All right, until next time.